So in the previous video, we went through adjustment one, two, and three. We finished up here with the adjustment change, VAT, closing stock, creditors, and purchases. So here we're just going to start with adjustment number four, which is to do with goods with retail selling price of €12,000 were returned to a supplier. This is correctly entered into the books, but then the retail selling price was cost plus 25%, and they issued us a credit note showing a restocking charge of 10% of cost price. So in this adjustment, we have to change creditors and purchases. And the whole step has been done for us here in terms of the return. All we need to fix is this credit note. So they've issued us a credit note, so we owe them money. It's going to change our creditors. And the restocking charge is in relation to purchases. So we're going to have to adjust purchases as well. So starting off, we have, first we're just going to try and figure out, well, how much do we actually owe? So we have a selling price of 12,000. Now included in that is obviously the cost for us. And then the markup or profit, the added charge that we've put on top after we've bought them. So the 12,000 represents cost plus 25%. Okay, so if you divide by 125, multiply by 100, you'll get 9,600 as the cost, leaving 2,400 for the profit. So this 9,600, this is the figure that we're concerned with here. This is our cost price. And it tells us that the restocking charge was 10% of cost price. So 10% of this is 960. And we need to add that to purchases and the creditors. Okay, and purchases. Okay, and both of those change in the adjustment just up above. So if we go up to purchases, we'll see that's 774. And creditors is 84880. So we need to adjust both of those. $84880 plus 960, because it's an increase in our creditors. It's more money that we owe them. We'll give it 85840. And we know creditors is a current liability. Purchases was 774 from the last adjustment. I need to add in the 960. So that's 774, 960, and then that's your new purchases there. So that's that adjustment finished. The next adjustment is provide for depreciation on delivery vans at the annual rate of 15% of cost from the date of sale to the date, from the date of purchase to the date of sale, sorry. So as I said in class, there's 6 steps involved in this, okay? So this is adjustment number 5, delivery vans. Okay, so step 1 is depreciation on the old van. So how long did we have the old van for? Well, it says we bought it on the 30th of June 2019 and sold it on the 30th of April 2022. So if you add that up there, we had it for all of 2020. We bought it in 2019, 2020, all of that, all of 2021, and some of 2022. Okay, so there are the years we had it for. In 2019, how many months did we have it for? Let's see, when we bought it, so we bought it at the end of June, so we had it for 6 months. Had it from July to December. Here we had 12 months. Here we had 12 months. And in 2022, we had it for 4 months. So in total, that's 2 years. I'll just separate this here. 2 years and then the 10 months. So the 2 years, first of all, it's a 15% per annum rate. So 36,000 multiplied by 15%, multiplied by 2, because it's 2 years. That will give you 10,800. Here it's 36,000 multiplied by 15%, multiplied by, it was 10 months, 10 over 12, which will give you 4,500. In total, that's 15,300, and that's the depreciation on the old van. Okay, step number 2 is profit or loss on disposal of that van. So step 2, when we're doing a disposal, we have 5 headings: cost, depreciation, which will give us net book value, how much was the van worth, how much did we receive for the van, and then did we make a profit or a loss. Okay, so the cost of the van was 36,000. We just figured out the depreciation was 15,300. So the difference there will give you 20,700. That's how much the van was worth. We received an allowance of 18,000. It says in the question there was an allowance, which means we had a loss of 2,700. We received less than the van was actually worth. And a loss on a sale of van is in selling and distribution expense. Okay, step number 3 is the cost of delivery vans. So there's 3 things you have to look at here. We have the trial balance, which is what's given in the question. Then we sold one, so that's going to reduce the cost of our vans. And then we bought one, which will in turn increase the cost of our vans. So in the question, cost of our vans is, see, delivery vans, 175,000. Let's check the adjustment. It says the one we sold was 36, so that's going to come down by 36. And then the new one was 45,000. So that's going to bring our vans up to 184,000. And that there is a fixed asset. Okay, that's step number 3 finished. Step number 4 is the depreciation on vans for the year. So to do this adjustment or this part, this step, you need to look at when was the van traded in for a new one. That's the 30th of April. Okay, so that means for the first 4 months, what was the cost of our vans? That cost is what was given in the 12 balance, which is 175,000. Okay, and then for the last 8 months, so from May until December, it was the new amount which you just figured out above, which is 184. Now again, we know depreciation is charged at 15% per annum. So to figure out the 4 months, you do 175,000 multiplied by 15%, multiplied by 4 over 12. Okay, and that will give you 8,750. Okay, and then this one, we had the amount for 8 months. So it's the same sum, except it's going to be 8 over 12. 15% multiplied by 8 over 12 will give you 18,400. So you add those two together. So 8,750 plus 18,400, that will give you 27,150. And depreciation of vans is a selling and distribution expense. Again, write it down and put a circle around it so it stands out when you go back to the adjustment. And then step number 5, there's only 2 steps left. This one here is the accumulate depreciation. So that's from the vans from when we bought them to now. Again, there's 3 things you have to consider here. The depreciation from the trial balance. Okay, add this year's. which we just figured out above. Okay, and then less depreciation on the old van. Okay, so all of those have, well, the last two have been figured out in the question already for us. We just need to take the depreciation, accumulate depreciation from vans from the question, which is 175,000 minus 135,000, which is 40,000. Okay, and then we have depreciation for this year, which we just figured out, 27,150. So we're going to add that on. If you go back up a few steps earlier, how much was the depreciation on the old van? Over here, 15,300. So we're going to take that away. So we don't have that van anymore, so we don't need the accumulated depreciation in our accounts. So if you do that sum there, you'll get 51,850. And that's your accumulate depreciation, which goes in the balance sheet. Okay, and then the last step, if you go back to the note, so step 6, if we go back to this note here, it says that the check for the net amount of this transaction, or the bank transfer for the net amount of this transaction, was entered correctly in the bank account, but treated as a purchase of trading stock. So if we purchase a fixed asset, it's not trading stock because it's not something we're buying to resell. So we need to remove that from purchases. So how much is that purchases? We need to go back up through the question to see when we last changed it. And it changed in the last adjustment, I believe. So purchases is here, 774,960. 774,960. And then the bank transfer is for the net amount. Okay, so what is the net amount of the transaction? It's how much the new van cost against what our allowance was. So it's 45,000 minus 18 should give you 27,000. And that's the amount that we need to take out of purchases. That is the bank transfer. Okay, so if you do that sum there, it's 747,960, and that is your new purchases. That is that adjustment finished. So the next adjustment is to do with suspense. So note 6, suspense. Okay, so suspense figure arises as a result of the incorrect figure for the venture interest and a payment of 4,500 for PAYE entered on the incorrect side. So first thing you do is find out where is suspense included. It says suspense is in salaries in general. So what I always do is just draw out that account, salaries in general. I'll redraw that. Okay, so salaries in general is an expense, so it's on this side. Remember, it's assets and expenses. On this side, we have liabilities and income. So 232,400. And the amount, or the incorrect one that we're looking at first is the venture interest. So the venture interest, well, we said we paid 4 months and that was 6,400. Let's do the maths on this one here and see how much it actually should be. So for this adjustment, we have entered how much? We entered 6,400 on this side. Now let's do the adjustment for the venture interest. So the ventures were adjusted on the 4th of June. So for the first 5 months of the year, it was valued at 220,000. Okay, so for the remainder of the 7 months, we had a top up of 60,000, which brought up to 280,000. And the percentage rate is 6%. So if you do 220,000 multiplied by 6%, multiplied by 5 over 12. And here it's going to be multiplied by 6%, multiplied by 7 over 12. If you do both of those sums in your calculator, you should get here 5,500, and here you'll get 9,800. So add those two together, and that'll give you your total amount for the year of 15,300, and that goes in the profit and loss. So that's how much we should receive. Oh, that's how much we should pay. Sorry. So it's a debenture interest, so it's an expense for us. So we should pay 15,300. We've paid 4 months. Now, how much is 4 months? We said here it was 6,400, but let's actually calculate it. For the first 4 months, it was 220,000. So we know how much 5 months cost. The first 5 months were 5,500. So to figure out what 4 months equals to, we get 5,500 divided by 5, multiplied by 4, and that'll give you 4,400. Which means the amount that's due is 10,900, and that is a current liability because it's due to be paid by us. Now, this amount here, the 4,400, we should have that in this account here, the debenture interest. We should have, this should be 4,400. So to reduce this to 4,400, we have to make an entry on this side of 2,000. Hey, whatever entry we do on this side of this account, we must go to the account where the suspense is and add it on the opposite side, which means you have to put 2,000 here. Okay, so that's that part of the question done. The next part is to look after the PAYE. PAYE, PRSI, and USC, but we'll just write out PAYE for now. And we know PAYE is a liability. It's on this side, 48,200. Okay, and let's see what we did wrong here for this one. So it was entered on the incorrect side of the account, and it was a payment. So if we make a payment, it should reduce our PAYE. To reduce our PAYE, we should enter it on this side. Instead, we enter it on the credit side. We entered it here. So we need to remove that 4,500. Okay, so now we've removed the mistake where we entered it on the wrong side, but now we need to look after the actual payment again. So we need to add another 4,500. Because if you enter something on the incorrect side, to fix it, you need to double the amount on the opposite side, which means 9,000 in here, which will bring our PAYE down to 39,200 if you get the difference between those sides. And PAYE is a current liability. So that'll go in the balance sheet. And this here, 9,000 in total, will go into suspense on the opposite side. So that 9,000 will go in here. So now if we add up the biggest side and minus the 9,000, we should come out with 225,400. And we know size in general is an admin expense. Okay, so that's adjustment number 6 finished. The next adjustment is all to do with buildings revalued. So we go down to the next adjustment, adjustment number 7. It says the company revalued land and buildings on the 1st of the 1st. Okay, the land and buildings element of this was 300,000, and then the revaluation wasn't reflected in the accounts. After that, we need to depreciate buildings at a rate of 2% of cost per annum. Okay, so this is adjustment number 7, revaluation. So we've changed the value of buildings. Now, if we've changed the value of buildings on the 1st of the 1st, we want to know, well, how much were they worth before we revalued? So we need to get the cost minus depreciation, that'll give us the net book value. So the cost of buildings in the question is 950,000. Depreciation is 120,000, which will give you 830,000 for the net book value. Okay, so that's 830,000. That's how much buildings were before we revalued them. Now we need to get the difference between the net book value and the revalue amount. So it's worth 100. It was worth 830,000. We revalued to 1.1 million. Now the difference between those figures is 270,000, and that is what we call revaluation reserve, and that goes in the balance sheet in the finance by section. So finance by section of the balance sheet, revaluation reserve, 270,000. Okay, the next step now, we need to depreciate buildings at rate of 2% of cost per annum. The reason why it says buildings are not land and buildings is because land does not go down in value. So we know land and buildings is worth 1.1 million. Right. Land is worth, it tells us in the question, is worth 300,000, which means buildings is worth 800,000. Depreciation is 2% of buildings, which is 2% of 800,000, which will give you 16,000. Depreciation of buildings is an admin expense. So put that in and draw a circle around it, just label it as an admin expense. Now, what is the new value of land and buildings? Well, it's 1.1 million minus depreciation. So cost is 1.1. Depreciation is 16,000 to give you a net book value of 1,084,000, and that there is a fixed asset. Okay, the next adjustment is to do with incorrect bank balances. So when you're doing this, you need to write down the two separate figures that we have for bank. So it says the figure for bank in the trial balance has been taken from the firm's own records. However, bank statement has arrived showing an overdraft figure of 31,200. So we have two different bank balances. Okay, this is adjustment 8. So bank balances don't match. So you have our bank balance. So our balance and beside that, we're going to put the bank's balance as well. Okay, so to consider this part of the question, we need to think, well, what did we know about in terms of these transactions and what did the bank know about? So first, we're just going to put our bank balance in. So our bank balance is taken from the trial balance, which is 33,400. It's on the credit side, which means it's a liability. Remember, we have liability and income, and this side here is assets and expenses. Okay, so we have 33,400, and the bank statement which arrived shows 31,200 of an overdraft, which means it's on this side. So the first transaction, credit transfer of 900 had been paid directly into the firm's bank account on behalf of a debtor recently been declared bankrupt. So if it arrived into our bank account directly, it means we don't know about it. So the bank knew about it, but we didn't. So if money was received into our bank account, it goes on this side, 900. Okay, now we need to look after, well, what's actually just happened there. So we received a credit transfer of 900. So we've put that into our bank account. But what was the money for? It was for a debtor who'd recently been declared bankrupt. So if someone's bankrupt, it means they're out of business, so they're not going to pay us back. So debtors is going to change in this question. And debtors is 92,300. I know when we're removing debtors, we need to see, well, how much did they owe us in total? So it says we received €900, which represents 30%. So 100% is going to equal €3,000. Okay, so that's how much we're going to take out of debtors, 3,000. To give you 89,300. Debtors, is a current asset. So label it CA. So that's the 3,000. We received 900 of it. So how much did we not receive? So did not receive 2,100. And that money that we didn't receive, we're never going to receive it because they're bankrupt. So that's a bad debt. Okay, and a bad debt is a selling and distribution expense. Okay, so that's that part of the question finished. Next one, a check issued for 1,300 to a director and not being presented for payment. So that just means that the director never actually cashed the check yet. So if we wrote the check, we know about it, but the bank didn't know about it. Okay, so we need to adjust the bank's balance because obviously they're not aware that we wrote that check yet. And if we write a check for someone, it's going to reduce our bank balance. So it's going to go on this side, 1,300, which will give you 32,500, and that's a current liability. Now our bank balances should match. So let's check the other side. So it's going to be 33,400 minus 900 will give you 32,500 of a current liability. Okay, so 32,500, you can see those figures both match. So that is that adjustment finished. And the last adjustment is adjustment number 9. So the first one provision to be made for investment income due and debenture interest due. We've already looked after that one. So then we don't need to do that again because we did it in the earlier adjustments regarding suspense. So in suspense, we looked after debenture interest due, and in adjustment number 2 with patents, we looked after investment income. So we don't need to do those again. So we can skip one. Part 2 is equipment depreciation. And it's 10% per annum on reducing balance basis. So reducing balance basis just means the net book value of the equipment. So we need to figure out what is the net book value of equipment and depreciate at that amount. Okay, so we have cost, depreciation, and net book value. So the cost of equipment in this question is 65,000. Cost is 65. And this figure here, the 32, that's the net book value figure. It's not labeled as depreciation, so we're going to assume it's the net book value figure, 32,000, which means the depreciation must be the difference of 33,000. Now we need to depreciate 10% per annum of the net book value. So depreciation this year is 10% of 32,000, which is 3,200. And that is an admin expense. Okay, so now our accumulated depreciation is 3,200 plus 33,000, which is 36,200, giving you a net book value of 65 minus 36,200, which is 65,000 minus 36,200. Let me double check that. Which should give you a net book value of 28,800. And that is a fixed asset. Okay, last part of that adjustment. Actually, second last part, adjustment number 3 of that is provision for bad debts. So it says to adjust the provision to 6% of debtors. So we have an old provision, have a new provision now. So the old provision is always given in the question, which is 6,200. Okay, the new provision just changed in adjustment number 8. It's asks us to do a percentage of debtors, and in this question it says 6%. So you need to know, well, how much is debtors? So if you go to row number 8, you'll see debtors changed to 8,9,300. And 6% of that. So 6% of 8,9,300 will give you 5,358. That there is subtracted from debtors in the balance sheet. So minus from debtors. The difference, it's a decrease of 842. And that there is added before operating profit. So that will go in the profit and loss. Okay, now it's the last one. And the last one is on corporation tax. So part number 4, corporation tax. Okay, so there's no adding or subtracting with this one here. It just says corporation tax at 35,000. So first of all, it'll go in the trade profit and loss. I'm going to subtract or minus after debenture interest for the year. Okay, and we haven't paid it yet. So we should have paid it. We haven't paid it yet. So it's a current liability. So we'll go in the balance sheet as a current liability. And that is that question finished in terms of the adjustments.